Tell me if this sounds familiar. You work hard, you're mindful of your money, and yet you just can't seem to get ahead financially. It's not that the game of life is rigged against you. You just aren't playing it the right way. What you need is a fresh approach, and author Nick Maggiulli has it. Let's hear his playbook that can help you hop off the financial hamster wheel and start climbing the wealth ladder. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, the show that helps you level up your financial knowledge and sharpen your investing skills. Presented by TD Direct Investing, named Canada's best online brokerage by the Globe and Mail for 3 straight years and counting. I'm your host, Rob Moise, and I won't try to hide it. I'm incredibly excited for today's conversation. I thoroughly enjoyed Nick's last book, Just Keep Buying. You could probably make a drinking game out of my many references to it on this show. Well, Nick's back with a new book, and it's another instant classic in my humble opinion, so we're going to hear all about it. Joining us is Nick Maggiulli, author of The Wealth Ladder, Proven Strategies for Every Step of Your Financial Life. He's also the Chief Operating Officer of Ritholtz Wealth Management, and he's the founder of the personal finance blog of Dollars and Data, also one of my faves. Nick, welcome back to the show. Pleasure to have you with us once again.
Thanks for having me back on, Rob. Appreciate it.
So, Nick, this concept of the wealth ladder, a fascinating one. Just lay a little bit of a groundwork for us. Help us understand, what is the wealth ladder? What does it look like as you see it?
It's a new framework for thinking about your financial life in stages, or what I would call levels, wealth levels. And so there are 6 wealth levels, and each one of these wealth levels has different strategies around your spending, your income, and your investment. So at a very high level, those 6 wealth levels are based on net worth. So you take all your assets minus all your liabilities, you get your net worth, and then you fall somewhere on that ladder. And we can definitely go into that more.
So what inspired you to write this book? Because it's a really interesting concept. It definitely sort of pushes back on the sort of really general advice when it comes to finances and personal wealth that often don't land for a lot of people. So what inspired you to write this book?
I realized when I wrote Just Keep Buying, I put out a one-size-fits-all solution, and I think it's a very good solution, but it's not perfect for everyone. There's certain people where Just Keep Buying is not going to be the right advice yet. They're a little bit, too early in their journey. And then there's other people who want to get extremely wealthy, and for them, Just Keep Buying a long-term, just buy the S&P 500 or just buy, global stock bond portfolio is not going to be the solution for them to get to extreme wealth, right? So I had a nice, solution for the middle, but I didn't have a solution for the tail end. And so the wealth ladder was me zooming out and kind of creating a larger framework to work on for wealth building.
And I mean, everybody obviously wants to climb the wealth ladder. Why do so many people struggle to do it in your view?
I think it depends. There's a few different factors. So for most people, I think it's an income problem. It's not generally a spending problem. That's what the data shows, that as your income goes up, you tend to be able to save more. And so savings rates tend to increase with income. And as a result of that, those people can build more wealth. So I think a lot of people aren't focused on their career enough. And then there's another subset of people who maybe they do have a good career, but if they're really trying to get to the higher end of the wealth ladder, their problem is that their strategy is they just keep doing the same thing over and over. And that strategy will eventually limit them. So if they're like, oh, I'm just going to go to my job, save money, etc., that works fine into getting you to level 3 or maybe even level 4. But to get past that, you have to change your strategy completely.
Yeah, it's the way that the book gets you thinking about some of, I guess, the hidden opportunity costs of decisions you do or don't make. I found absolutely fascinating, and I think it'd be helpful to a lot of people, depending on, regardless of whether, I should say, they're on whatever part of the wealth strata here. One of the things I found really interesting, it's a little aside that you sort of have in the book, but I think it's one that would also kind of resonate with everybody, is this idea of wealth and happiness and the connection between them. Everybody thinks that if I move up the wealth ladder and I have more money, of course I'm going to be happier. We've seen some studies that sort of suggest that that's not necessarily the case, but there's conflicting evidence. Based on what you saw, where do you stand on that issue?
Yeah, so everyone's probably heard the study, the famous Kahneman-Deaton study, that said, once you make more than $75,000 a year in income, your happiness doesn't increase past that. That was the original study that took over the world. Everyone's kind of read that study or heard about it at least. And there's a guy named Killingsworth who came out a few years ago, and he looked at the data again and actually did a new study, and he found that actually, no, that's not true. Happiness keeps increasing as income increases, right? But you just need a bigger and bigger jump. You need a logarithmic, a 2x, 3x jump to see the same size jump in happiness. And so he went back and forth with Kahneman. They looked at the data again, and they found that the original study was actually not completely correct. It was showing that unhappiness doesn't decrease beyond $75,000 a year. I know that's a double negative. It's kind of hard to wrap your head around, but long story short, more money can't stop unhappiness. So you can be unhappy no matter how much money you have. But in general, what the research from Killingworth now shows is that, yes, if you're happy, more money is going to bring you more happiness. But if you're not happy, more money is not going to necessarily do a thing, right? So it's like if you don't have any money, getting some money will definitely bring you more happiness. But beyond a certain point, unless you're happy already, more money's not going to bring more happiness. That's the kind of the main takeaway from the research and the studies now.
Yeah, and one of the things you also touched on in the book is that it's not just about money and financial wealth that determines your happiness. There's all these other things that go into it, and we showed a graphic on screen there just with some of the bullet point notes that we had there of the different types of happiness and the drivers of happiness. So, I mean, it's fascinating stuff. I mean, that's a whole other conversation we could have. But what I wanted to focus on in our conversation now is some of the ways that your everyday person, maybe they're in that level 2, level 3, they've got a net worth under $1 million, and they want to climb the wealth ladder into that 7-figure club. Let's focus on some of the ways that they can do that, some of the habits and decisions they can make. If you're in our audience and that applies to you, and you want to get in on this conversation and have a question for Nick, we would love to hear from you. You can definitely submit your questions to us on Webbroker. It's the questions box you want to use. If you're on our broadcast platform, it's the questions and comments box. And if you're watching on our YouTube live stream, you can follow the link in the description. That will take you over to the broadcast platform, and you can ask your question there. Okay, Nick, so before we kind of delve too much into the level 2, level 3 distinctions and stuff like that on the wealth ladder, I wanted to talk about some overarching things that I thought really resonated with me, and I think would with many people who read the book. The big one for me too was a spending one. This is the 0.01% rule of spending. Can you just take us through, like, how does this work, and how could that help pretty much anybody on the wealth ladder climb the wealth ladder to some degree?
The idea is that the 0.01% rule says take your net worth and multiply by 0.01%. Now that's 0.0001 or divide by 10,000. These are mathematically the same things. And that's the amount of money to you that is trivial. So once again, take your net worth, which is your assets minus your liabilities, everything you own minus everything you owe to others. That's your net worth. Divide by 10,000. And that's the amount of money that's, I would say, is a trivial expense. And so if you're ever debating whether to spend that amount of money and you're like, oh, I don't know if I should do it, if it's below that amount, just do it. It's going to be trivial. It's not going to be anything that's going to impact your long-term finances, right? And so that's the thinking behind it. And once you use that rule, you can then determine, okay, well, certain spending categories are going to be kind of trivial to you as you kind of gain more wealth. And so what I say is level 2, which is someone with $10,000 to $100,000. I call that grocery freedom. So at the very beginning, once you have if you have $10,000 in wealth, that's not a lot. So you don't have a ton of grocery freedom. But by the time you have $100,000 in wealth, how much you spend at the grocery store is not really going to impact you, right? Level 3 is what I call travel freedom, and this chart will show this kind of a bit. Level 3 is restaurant freedom. I apologize. That's going to say, like, hey, when you go to a restaurant, if your net worth is between 100,000 and $1 million, by the time you get to $1 million, how much you spend at a restaurant doesn't really matter anymore. Level 4 is travel freedom, and et cetera. So you can see that this simple rule, just take your net worth, divide by 10,000, can apply up and down the wealth ladder, and it makes it really easy to determine if a certain spending decision, whether you should worry about it or not.
Nick, I'm in level 3, and I probably will use this as ammunition next time my wife says we probably shouldn't go out to eat. We should probably eat in. I say, hey, look, we got restaurant wealth, okay? We can go out. We can have a nice glass of wine. We can have a nice fancy meal. Although, of course, with this rule, I think maybe the hedge to that is that, of course, you still have to be judicious with your spending. Like, you can't just go crazy, right?
Of course, yeah. And so the idea is it's mostly on the marginal decision, right? I think everyone makes decisions on the margin, right? If you're in level 1, so let's say you have less than $10,000 in wealth, you're not at the Ferrari dealership. You're not even debating. You can't afford that, right? So I think it's like, oh, I'm in a restaurant. Do I get the salmon for $35 or the burger for $25, right? A high-end restaurant or something like. And that's the question. It's that marginal $10 decision right there. That's what you're debating about. And I'm saying if your net worth is over, let's say $100,000 in this case, don't worry about that. Just get the salmon if that's what you want, right? So I think that's where the thinking is, trying to allow a little bit more spending freedom as you build wealth.
Yeah, and that spending freedom can also, contribute to the happiness factor, right? And making your money work for you a little bit better, right? One of the other habits that I wanted to touch on too, this is the 1% rule of earning, let's call it. Take us through this one. How does it work? How can it help your everyday person move up the wealth ladder?
So The 0.01% rule is for spending, right? Multiply your net worth by 0.01%. The 1% rule is for income, right? So you take your net worth, you multiply by 1%. So that's zero point zero 0.01 in the calculator, divide by 100. And that's going to give you the amount of money that you should really be like your lower bar for what you should consider in terms of an income opportunity, right? So if you're like, hey, do I want to do this side gig? Do I want to bring on this new client? Whatever type of work you're in, if it's not going to improve your net worth by at least 1% in the long run, you really need to reconsider whether it's worth your time, right? And so if you don't have a lot of net worth, almost you should be able to say yes to basically everything because you need to make extra money. But at some point, the value of your time is in theory going to go up, and you're gonna be like, yeah, maybe I shouldn't be doing that anymore because it doesn't move the needle as much. And so that's the thinking behind it. It's not a perfect rule because, of course, you need to adjust for how much time it takes to do something. But just thinking about it, it's another tool in your toolkit when you're making certain career decisions.
Do you find that there's people at level 2 or level 3, let's say, that focus on a certain type of income generation that isn't necessarily giving them the best like money for time trade-off? Is there any sort of trends that you noticed in the research that you were doing?
I didn't look at like micro level decisions around like these types of things. I think the thing that I would have noticed the most is that people in, let's say, in level 2, I don't think that happens too often. I think in level 3 is where it can happen is people just get, they get stuck in a certain place and they just keep doing the same thing year in, year out. They get their annual, like basically inflation adjustment raise. So they're not really gaining real purchasing power. And they just do that their whole career. And they don't really think about, oh, should I do something else? Should I really change it up? Should I come up with a different strategy? Right. And so I think it's easy to get comfortable and there's nothing wrong with that. But if you are trying to progress financially, you need to sometimes like shake things up. And for you, this could be like the wake up call, like, hey, this book or this strategy is an idea, a way for you to rethink, do I need to take a different approach going forward?
Mm-hmm. I want to talk about one more habit that can kind of more broadly applied to people on the wealth ladder. And that's this idea of buying a diverse set of income producing assets. You could be stocks, bonds, real estate, commodities, what have you. So many to choose from. One of the things that I found interesting though is that when you look at the upper levels of the wealth ladder, you generally have to create your own business and take on some kind of entrepreneurial venture in order to get there. So I could see some people wondering, well, why should I focus on all these other income producing assets if I want to be at the tippy top of the ladder, I need to start my own business? Why wouldn't I just focus everything and all my efforts on that?
And it's a good argument to make because that's what some people do. They just focus on entrepreneurship their whole career. The problem with that, or the difficulty, I would say, is just it's not easy to start a business. You need to know something about a given industry. You have to compete against other business owners, right? And a lot of times you have to have some sort of capital or some sort of money to start that business, right? So if you can solve the capital problem and you have the experience, which tends to mean you're a bit older, then great, you can go start a business. I just think a lot of people, especially those people in their 20s, it's very difficult because they don't have the experience yet and they usually don't have the money either. So going out and starting a business is not only risky, but it's difficult. And that's why those rewards end up accruing to a small percentage of people because they took that risk and it was a difficult journey to get there. And I talk about this in the book. Even Jensen Huang, who's the founder of NVIDIA and one of the richest people in the world and one of the most successful people ever, he said, like, if I go back, I wouldn't have done it. It was way more difficult than I would have thought. And this is from one of the successful business owners. Imagine what the unsuccessful ones say, right? So I think you need to think through this before you go and decide to start a business.
Yeah, I guess there's also the point too, we often hear that investing and diversification through investing is kind of one of the only free lunches that you're going to get out there. So I suppose maybe that's almost like a backstop. If you do eventually want to try your own business, at least you have something else to fall back on if it doesn't pan out, right?
Yeah, and I think that's what the data shows is those people that actually start businesses and actually tend to do the best are those that are usually a little bit older, so usually in their 40s and 50s. They've had experience in the area, and they have some money. So even if it fails, it's not like they're going to zero. They're just like that money they put into that business didn't go anywhere, but they have things to fall back on. I think it's good to have that, which is why a lot of people have side hustles. Like I have a main job. I'm a COO at a wealth management company. All this stuff I do with content is a side thing. If it doesn't work out, if it never worked out, it would have been fine because I still would have had a job. So I think a lot of people do that kind of, hey, I have a main job, but I also do the side thing. And I think that's great. I think it's the way to do it because it de-risks a lot of your life when you do that.
Yeah, and we're going to get into that kind of stuff a little bit later, but I wanted to get a little bit specific. On level 2, you have some great suggestions for folks. And again, this is people with a net worth between 10K and 100K. What do you think that are some of the things they should be focusing on to help them climb into that next rung of the wealth ladder?
Yeah, so there are two types of people in level two. There's those people who maybe they're younger and they kind of just started working and they haven't had the time to get out. And so what they really need to do is just be patient. And then there's those people who are in level two, have been there for a while, and they're probably just not earning enough money to be able to save. And so I think the big unlock for them is finding ways to increase their skills over the long run so that they can increase their income. And I don't mean this like, oh, you're going to go do some Googling tonight and you're going to find the one thing and you're going to just solve your income problems. No, it's a multi-year process, and you have to really find something that you can spend and dedicate a lot of time to build that out. And for a lot of people, that means education, not necessarily a degree, but there's different types of education to build the skills to advance your career.
Yeah, we often hear that education is, one of the best investments that you can make. Although that said, education is incredibly expensive these days. On some metrics, more expensive than it's ever been, and the competition is even more fierce too. So there's a little bit of a risk-reward trade-off. Do you have any sort of like rules of thumb or anything that can help people decide whether taking on perhaps the student debt that they might need to earn, a more advanced degree is worthwhile for them?
It's a great question, especially now with AI is starting to kind of get rid of some entry-level jobs that normally would have gone to someone who just got out of college. So I think it's tough we can't know the future, unfortunately. The one thing though is like focus on, okay, is there a lot of demand for this job, and could AI do that job? I think those are the two big things. Like right now, if I was going into college, the thing I would focus on whatever you want to major in that thing, but in addition, learn how to sell. I think sales is the future for a lot of high income earners. And it's always been a high income career, because I don't think we're going to be buying homes from robots or robot realtors, even if the fees come down a bit. I think it's always going to be a relationship based business. I think sales is always going to be person to person. Maybe I'm wrong on this and AI ends up selling everything in the future, but I really think that is going to be a personal touch that I don't think LLMs can currently do or will be able to do for the foreseeable future.
Just speaking of AI, just really quickly, do you think that AI is generally going to help or hurt people trying to climb the wealth ladder?
Depends how you use it. I mean, I think for a lot of people, it can help actually. And so for me, like I use it in ways to help save time. I use it in ways to help me do research on personal things that I may have paid a professional to do. And like, it's just like I want to bounce ideas off before, maybe even before I see a professional. So there's different ways you can save time and you can use it to do research. Like I use it to grab research and find interesting sources on different things that I write about, right? So I'll have it go do that. I don't have it write the post. If you can tell when something, if you write enough AI writing, you can tell when it's written by AI. So I still do all the writing, unfortunately, but for the time being, like it's very good to find sources and find, good pieces of information out there, because they're out there, and then finding them and then adding it to your work can be very valuable.
One of the things that you talk about in the book that I think would apply to a lot of people is this idea of opportunity cost in your career. And this is often an invisible problem that people have. To your point, like people get comfortable and, you might not know that you need that jolt to move up the wealth ladder, get yourself going in a different direction. Do you think that there's any sort of rules of thumb or anything that they can look for that can help them understand, I think now is time to make a change. I need to do something to propel myself forward?
Yeah, I think there's a few things you're going to want to think about. Think about if you just have a job, let's say, let's keep it very simple, right? You have a job, you've been there a while. Like, have you been getting increases in pay? Have you been getting increases in responsibility? And do you enjoy the work? The answer is no to all three of those things. And it seems like it's going to be no for the future. Like that's the type of thing where it's like you're probably in a dead end job, right? We like to think about mistakes as things you do that you shouldn't have done. That's one type of mistake. The other type of mistake is not doing something that you should have done, right? And so that's the mistake of omission. That's the kind of opportunity cost that you talk about. And so I think those are the bigger mistakes that people make because they have no idea what their life could have become if they had taken a different route. And so you don't see that mistake as visibly, but it definitely exists.
Mm-hmm. Okay, I want to move on to level 3 on the ladder. Again, this is people with between $100K and $1 million of net worth, and they want to get into that 7-figure club. Who doesn't? That's a nice number to talk about. What do you think that they can do to climb the wealth ladder?
I think the biggest thing they can do is to start investing if they haven't already, and to keep investing, right? Because I'm not saying you shouldn't invest when you're in level 2 or level 1. I think everyone should start investing no matter what. But by the time you're in level 3, that's where, it's 10x bigger. Your portfolio is 10 times larger than someone in level 2, right? On average. So as a result of that, you're going to just have so much more firepower there. And that's going to, all the compounding is going to help it grow much more quickly. And your portfolio can start to compete with you and what you can save in a year, right? And I think, and what you can earn, right? So that's where I think investing is one of the big things there. And also, I've talked about side hustles. If you think you're maybe hitting a peak in your career, like, is there something you can do on the side that you love more and doesn't need to monetize right away? I didn't make any money for 3 years. My first 3 years of writing, I made $0. I just did it because I loved it. And I eventually, hey, this is kind of cool. Maybe I can turn this into a book, right? Like, things just happen as you start putting yourself out there and just taking a lot of at-bats and just, doing that stuff. You can see like these positive, unexpected surprises that can happen in your career. And that's what I really recommend people try, because you'll meet people, you'll learn things, and you just have to take a lot of action for that to happen, though.
On the investing side, one of the things I thought that was really interesting, and we showed this chart just momentarily ago, this idea that like the contributions that you make early on, the impact that they make on the overall portfolio that you end up with is so powerful. And I think that there's a lot of folks out there that say, you know what, I'll just invest tomorrow when I have more money, or I have more time, or I have more knowledge, or whatever the excuse may be. And they could be really missing out on some gains. And I thought this was just a beautiful chart. I was wondering if you could just speak to that a little bit more and help people understand just the impact that they might be missing out on if they don't get going sooner rather than later with investing.
Yeah, so in this simulation, we just assume a constant rate of return. I think it was like 7% a year. And if you're saving the same amount of money every single month, and you do that every month for 40 years, over half of your portfolio value comes in the first 10 years. So think about that. The actions you took in the first 10 years are equal to the actions you took in the next 30. And that's only because of compounding, because that constant, that money, earning money, which earns money, right? That kind of like fractal nature of this money earning its own money, that builds on itself in such a way that those earlier periods end up counting for so much more than the later periods, right? And it's not that the later periods don't matter at all, they just don't matter as much. And so because of that, because your money's had more time to compound, that's where it really makes a difference. And I know even people say, well, Nick, that seems so crazy. You can't be investing right now. The market's so overvalued. I've been hearing that since 2017. And I know, trust me, we can talk about some of the overvaluations and stuff I'm seeing out there. But like, I've been hearing that same argument since 2017. And look at like the market's gone gangbusters since then. So I think it's one of those things where you really need to, be careful by thinking that and sitting it out, because the market can go up even more as you're doing that.
I did want to get to that. So since you bring it up, let's dig into that a little bit. One of the lines that you had in your last book, Just Keep Buying, that I love referencing is, even God couldn't beat dollar cost averaging. I thought that was such a powerful statement, and the way that you showed how that was the case is incredible. But I think a lot of people are worried about overvaluation in the market, particularly in the U.S. stock market. We were just talking with Vanguard the other week, and they were talking about how they see a 30-70 portfolio outperforming a 60-40 over the next 10 years, in part because of the overvaluation that's there. Should people be concerned about that overvaluation? Like, what do you do with that information if you're someone who wants to climb the wealth ladder?
I do. I see the concern. I think it's valid. I think there is some, with the AI stuff, all the money and the off the balance sheet activities and the special purpose vehicles, all this stuff is a bit concerning. What you do is what I call sin a little. So if your ideal portfolio is an 80-20, you just kind of make a slight tweak off of that. Like maybe you go to 75, 25, maybe you go to 70-30, but you don't make a massive shift. I think going from a 60-40 to a 30-70 is going to be a mistake. Even if it does outperform, I think it's one of these things where it's too much of a move and it's too, I think, alarmist. And I think it's very difficult to know the future. And so while things look overvalued now, they can stay overvalued for a long period of time. And that doesn't mean that the stocks necessarily need to crash. They could just sizzle for the next 10 years. And, relative to other things, like I think maybe it's just, the answer is just, okay, you make a slight tweak and you just keep buying and you focus on other things, right? What the market's going to do over the next 10 years is probably going to have less of an impact than what you can do in your career or other decisions you're going to make. So don't get me wrong. If you're retired and like all your money's sitting in US stocks right now, you're 100-0. Yeah, you probably need to make a bigger move. But if you're not, if you're like in the accumulation phase, like many of us are, that what's the stock market's going to do over the next 10 years will have a much smaller impact on your overall life. And I think I will, in 10 years from now, you'll be like, oh, it seems like it's really that important, but go further through your life and you'll be like, oh yeah, these decisions I made in 2025 were far more important than what the market did through 2035.
Yeah, I mean, to some degree, if you have a long enough time horizon, you can sort of look through some of this volatility. The bit that I loved in Just Keep Buying around the dollar cost averaging versus buy the dip. Everybody wants to buy the dip. Nobody wants to buy overvalued stuff. But the example that you gave where if you had waited to buy the dip, you actually would have done worse than someone who just kept buying along the way, because you have to wait so long to get a big enough dip to make it worthwhile. I thought that was just like a great little bit. So there's a plug for your last book, including your first book, or your latest book here. But in any case, one of the things that I think a lot of people appreciate when it comes to investing and this whole idea of just keep buying is the simplicity of something like index investing. And I know you're a fan of that as well too. We recently spoke with an early retiree, Jackie Cummings-Koski, and she talked about why she feels that something as simple as just having an S&P 500 index ETF as your entire portfolio and just keep plugging away at that can be all that you need to retire one day. Let's hear what she has to say on that.
You want a little bit of balance, but you don't need all these different, asset classes and sizes of stocks and things like that, because something like an S&P 500 index fund or total stock market index funds, it has a lot of diversification within there, even perhaps a lot of international, because a lot of these companies that's inside these funds, these stock index funds, they have huge international exposure. And most of their growth is probably internationally, where they have maxed out maybe in the US and Canada.
Okay, so I think the logic of simplicity there is pretty appealing to a lot of people, and I can see how that could make sense. But Nick, we're talking about people who want to climb into level 4. Do they need something more sophisticated of an investing strategy than just an S&P 500 ETF or whatever index fund they want to use?
I mean, no one needs any of those things in particular, right? I mean, in theory, you could do this. If you have a high enough income, you can just save in a savings account and you can get to level 4, right? Like, if you imagine you're like, Dwayne The Rock Johnson, like, do you think it matters what his investment portfolio is? Like, no, he makes so much money from his movies that none of that matters. Now, I know that's a extreme example, but you get my point, right? At some point, your investment portfolio doesn't matter. I think the thing that we need to think about, though, for most people is like, this is a very popular take. Oh, just buy U.S. stocks only. It's the only thing you need. But I think it doesn't take into account risk. And you're not thinking about, well, when the market, like, how did you react in March 2020, right? That's the big question. If you were absolutely unfazed by it, yeah, maybe 100% stocks could be okay for you. But if you were worried, you started selling. Like, I think there's a lot of people that don't know what it's like to go through a real, drawdown. And I think when the market was down 33%, in March 2020, how you felt then is probably more indicative of how you might feel in the next big crash that happens, whenever it does happen. And it will happen, it's just a matter of when. So I'm not a biggest fan of that strategy, only because it's just worked very well over the last decade. Doesn't mean it's going to work well forever. And I know it's popular and simple, but I do think you need to consider other funds and other asset classes to diversify a bit more.
Okay, so great food for thought. I always do find it interesting. Sometimes we hear, especially with younger investors, reference the COVID crash. And it's like, hey, look, if you just held through the COVID crash, that was easy and everything worked out fine. But that was also one of the fastest recoveries that we've seen in the last 100 years. So it might not be indicative of truly like what you might experience. Speaking of things that we've heard from other investors, we also heard from DIY investor Craig Stevens a while back. He was explaining why he feels that building an opportunity fund, as he called it, some dry powder on the side, cash on hand, can help you accelerate your wealth after a market crash. Let's hear what he had to say.
Cash is king, right? And you look at Warren Buffett's portfolio, he's got something like $350 billion in cash just sitting there waiting. Now, we shouldn't be acting like Buffett. He can do what he wants, but when things went sour, he had the cash to move. And if you don't have cash to take advantage of these price disparages where you might be able to get a discount on a specific asset that you're targeting, if you don't have cash, then you're not going to participate.
So, Nick, I think Craig makes an interesting point there, but I'm curious your take. Yay or nay on the opportunity fund as a way to help climb the wealth ladder?
No, I don't believe in these types of opportunity funds. I think the data is quite clear that saving cash to buy the dip or for these opportunities doesn't work consistently. Like, yes, people have done it once in a while, but if you had been holding cash to buy the dip, since 2012, when would you have done it? You're like, oh, I would have done it in March 2020 in COVID. I bet you would not have. If we could go back to February 2020 and the market started to crash, and I even said, hey, you need to get out, and I just gave you all the headlines, just the headlines, not the stock market. You're going to see the headlines over the next year. When would you have got back in? I guarantee not a single person would have said March 23rd, 2020. Not one person, but that was the correct answer. So even if you have this opportunity fund, when everything starts crashing, how do you know when to buy? Because everyone wants to get the best price. When would they have purchased? I'm telling you, most people would not have picked the right time. And because of that, I do not agree with these funds whatsoever.
All right, fascinating pushback. Appreciate you weighing in on that one. We got a lot more to get to, but quick question to our viewers here. Are you enjoying the show so far? I know I'm enjoying the conversation. If you're enjoying things and you want to check out more of this kind of content, make sure you follow TD Direct Investing on YouTube, Instagram, and Facebook. You can get a sneak peek at upcoming episodes we've got on this show and others that we have, as well as a ton of other content designed to help build your investing knowledge. And speaking of interesting content, we've got a new episode of the Money Talk podcast that you want to check out. Let's have a listen.
So if you think about it, communication is Homo sapiens' superpower. It's the thing that has made it possible for us to build families and villages and towns and aircraft carriers and video game consoles. Without communication, we're not that special.
That is Charles Duhigg, Pulitzer Prize-winning journalist and author of This Book, and most recently, this book, Super Communicators. So why does he think it's important to be a super communicator?
They tend to do better in almost every setting. They're more popular, succeed better at work, they're better at getting deals, they earn more money, they tend to be happier and healthier as they get older.
And how hard is it to become one?
Nobody is born a great communicator. Nobody's born a super communicator. There's a handful of skills that make us good communicators. When we practice those skills until they become habits, that's what separates the best communicators from everyone else.
You can check out the full episode on Spotify as well as Apple Podcasts. You can also check out past episodes there too. Make sure to check it out. Great, fascinating episode. Super communicators. Speaking of super communicators, we're talking one right now, in my humble opinion. We got a live Q&A coming up too. So make sure, if you haven't got your questions in for Nick, make sure you do. Before we get to that though, I want to bring in my colleague, Caitlin Cormier. She's going to show us how investors can chart their path up the wealth ladder with some of the tools that TD offers. Caitlin, welcome back to the program. Always lovely to see you.
Absolutely. Not in studio this week, but always a pleasure to be here.
Well, you'll have to join us again here. But hey, we got you remotely. That's good too. Nick was talking about some of his spending rules that can help people climb the wealth ladder. What could somebody do to get a handle on their spending?
Yeah, absolutely. So budgeting is the key thing that we usually talk about, right? Is kind of understanding, being mindful about what money's coming in versus money going out. But if you're like me, you're maybe not keen on having that spreadsheet that you're constantly updating and keeping track of. And so what I like to use is actually the TD My Spend app. So it's an app that's literally on your phone. And I'll just hop in and kind of share my screen with you here to show an idea of what this app actually looks like. So what happens is, I'm just going to play this video in the background here. What happens is you go ahead and spend as per usual. If you have your banking with TD, if you've got like a credit card, bank accounts, all that stuff with TD, you go ahead and do your regular spending. And this app will actually take all of the spending that you do. And not only will it keep track of it, it'll categorize it. You can see all these different categories into like housing and shopping and eating out. It actually will tell you specifically what you're spending money on. So it's a really easy way when you're talking about that idea of overspending in certain categories. You can see really quickly where you might be overspending, and then you can kind of, make some adjustments to your plan for the next month. So it can be a really easy, passive way to really be mindful of the money that's coming in versus money going out, and be able to kind of maybe find some additional dollars, some areas where you can maybe cut a little bit and kind of keep track even throughout the month. You get those push notifications on your phone to show you how you're spending versus the traditional month and stuff like that. So I think this tool could be really helpful. I know for me, it's really helpful to really keep track of what's going on a regular basis within your accounts.
And I'm with you. I'm not a spreadsheet guy myself either. I will admit, though, I am terrified to see what TD My Spend would say about my restaurant spending habits. But it is for the best. So let's say somebody, they get a handle on their spending and they're doing a little bit better job budgeting. How can they put that money to work in their journey up the wealth ladder and keep track of how they're progressing?
Rob, there's a reason I'm not showing my personal TD My Spend account right now, okay? Nobody wants to see my spending habits either in certain categories. But if you are able to use this tool, you're able to maybe find some areas. I mean, even we think about subscriptions and stuff. Some stuff just happens that we don't even realize. So maybe you can find some extra money. And I'm gonna throw out the value of $100. Let's just say you found $100 throughout the month that you were able to save additionally. So what I'm gonna do is I'm gonna hop into our goal tool. So I've kind of pre-set up a bit of a goal here. So what it is a retirement goal. We've got an objective here, somebody who's 30, retiring at age 60, a $50,000 annual income, contribution of $200. You can see that they're a little short on their contribution room with the $200 bi-weekly going into the account. So if I was to actually increase, so if we increase by $50 and recalculate, we'll notice that we're actually getting even closer. And let's just do we'll do 275. We'll just increase a tiny bit more. And that is actually going to take us up a couple $100,000 at the end of the road. When we look at it here, it looks like a really small jump on the chart. But if you look at the dollars, like if I go from the 200 bi-weekly, we see that the amount that we're going to have is just under 1.3. And then when we go up to that 275 and we do the recalculate here, you'll notice in this case, we're almost at 1.5. So we're looking at a huge jump just by simply adding, $50 or just over $75 bi-weekly to our contributions over that 30-year period. We're seeing some huge returns in the end for compounding for that money.
I think this is a tool that it's a great source of motivation. I know I like to use it a lot too and just play around with the numbers. It's a great way to keep track and push yourself to do a little bit better, because if you don't have that goal in mind, sometimes it's harder to get the motivation, right? You'd rather just go to the nice restaurant like I do all the time and spend my money. So it's a great tool to use. Caitlin, thank you for showing us the ropes and how it's done. And hopefully we've inspired people to check out those tools as well. Caitlin Cormier, TD's Direct Investing Senior Client Education Instructor. Thanks as always for joining us. Okay, Nick, the time is upon us, the Q&A. Let's open the floor. Let's hear what people want to know more about. We got our first question coming into us from Amy. Amy says, you said sales is a key occupation in the AI era, let's call it. Are there any industries beside real estate that you recommend? And how can a new graduate excel in this field? So it might be tough for you to play career counselor here, Nick, but give it your best shot. Like, what do you think?
Yeah, so I don't think you have to go into real estate. I just think real estate is like one of the highest priced items that people tend to sell. But I think getting into any sort of sales, I know people have gone into tech sales. You have to get good at selling things. That's what takes time. And once you can do that, you're going to be, obviously it's very difficult initially because you're on commission or maybe partial salary, partial commission. And so it's really based on how much you can sell. But that's something that's not going to be automated away by AI whatsoever, in my opinion. So I think that's one place to focus in addition to there's other things that I think are not going to be automated away due to regulatory reasons or compliance reasons. But for the most part, I think sales is where to go. I don't know a ton about sales. I'm not a salesperson outside of, writing books as a form of sales. But outside that, I would say just look around and see where are other salespeople doing things and how can you learn how to do those types of things as well.
All right, Maureen's got a question for us. Let's see what Maureen wants to know. Maureen's saying, what are your recommendations for retirees in their early 70s who have a modest-sized portfolio? Of course, we can't give explicit financial advice, but in general, Nick, do you think you have any pointers for Maureen here?
Yeah, early 70s, I think the thing you're going to want to focus on is just being conservative with your investments. Now, I'm not going to give you a specific breakdown of 60-40, 50-50, whatever. It's going to vary by person. It's going to vary by risk tolerance. It's going to vary by your liabilities. Do you have children that need help or grandchildren that need help? Or do you have health issues? All those types of things are going to impact this. I think for the most part, the thing you want to focus on is just making sure you have some, emergency cash set aside in addition to having a relatively conservative portfolio. I don't have much beyond that. The other thing I think is helpful just for enjoying your life is focus on health more. I know makes it tougher on the money side because you'll end up living longer. And so that longevity is tougher financially, but you're going to enjoy your life more. And so that's the thing I would say to focus on. And I think no one's going to regret doing that by the end. So I would say to do that, which is more of a health thing, not a financial opinion.
Yeah, that actually speaks to some of the things you talk about in the book, those different levers of happiness that you can get beyond just your finances, and certainly keeping healthy is one of them. Just some incredible stats behind there. I won't give them away because it's fantastic stuff, but great food for thought for Maureen there. Thank you so much. Let's get to our next question. Let's see what we got on tap here. Chandler wants to know, at what mortgage interest rate would you prioritize paying down the mortgage instead of investing? I don't know that this is something you specifically addressed in the book, Nick, but it's a great question. Any rules of thumb that you can share?
Yeah, so I think in general, this is true of any interest rate you're ever paying. If the rate is over 8%, I say you pay it down first before you invest any money. If the rate's below 4, then you invest. 4 to 8 is the big, like, I don't know. And that's where most rates tend to be, especially nowadays. So if it's below 4, I say just keep the rate. It's not that high. If it's above 8, you want to pay it down as quickly as possible. In that middle zone, it really depends. I don't have a perfect answer. And that's because that's why you have this question, because it's kind of hard to know, like, is the market going to return, 6 to 7% a year in the US? Maybe, but at the same time, like, there's risks there. So I would definitely probably do a mixed approach in the middle, but anything below 4, I would keep the debt. Anything above 8, I wouldn't. So that's where it's at. So that's where you have to think about.
Yeah, great rule of thumb to consider. Yeah, I mean, we don't know what's going to happen in the future. Some of it is just the sleep at night factor. Would you rather just own your home outright versus having higher investment returns? If the answer is yes, like maybe you would want to lean towards paying down the mortgage. But a personal call either way. Let's get to our next question. This one coming to us from John. John wants to know, what was the biggest mistake you made climbing the wealth ladder? What did you learn from it? Interesting one. Nick, what do you got?
I think the biggest mistake for me was not realizing when I needed to change my strategy. Now, I didn't take that long to do that, but there were periods of my life where I was doing the same thing over and over, like for a year, probably longer than I should have. I probably should have started blogging maybe a year before. I should have considered writing a book earlier, maybe. And I don't know, maybe it's not a mistake. I can't really know, because you can't know the path you didn't take. I'm just thinking about this now, but there are certain ways where I probably should have switched my strategy a bit sooner in certain parts of my life. And I think because I didn't, that's actually gave me the realization to write the Wealth Ladder. So I guess if I hadn't made that mistake, I would have written the book. So maybe it's a positive thing. I don't know.
Well, I'm sure your readers thank you for making that potential mistake, because now they get this great book out of it. Interesting question, John. Let's get to our next question. This one from Uri. They're saying, why didn't you list cryptocurrencies like Bitcoin among the investments to consider when diversifying? I don't believe there was a specific call out to crypto like that. Your thoughts on crypto, Nick? How come that didn't make the cut for diversified investments that you think are worth considering? Or perhaps are they, and you just didn't mention them in the book?
I mean, they're definitely worth considering. I think it's the question of position sizing. So how much of the portfolio is going to be put into crypto or non-income producing assets? I think for the vast majority, 85 to 90, maybe 95% of your portfolio should be income producing. So that's like stocks, bonds, real estate, farmland, et cetera, right? That should all be income producing. And then you take that smaller portion of your portfolio, maybe 10%, and you put that into things like gold, Bitcoin, et cetera, different assets that you think could be valuable. And the reason I say that is because, yes, there is some diversifying power to owning these other assets, like owning things like art or owning things like Bitcoin or crypto. The issue is, at the end of the day, they don't produce income. They're only based on what other people are willing to pay for them. While income producing assets are definitely based on what people are willing to pay for them, at least at the end of the day, there's these like fundamentals of like, what's that thing is worth. Like, you can imagine a suitcase with $50,000 in it. People might debate how much money's in it, but we know there's money in it, versus a suitcase that has no money. We know there's no money in it, but people are still willing to pay a lot for it because, I don't know, it's a cool suitcase, right? So those are very different things. And one of them is an income producing asset. There's a fundamental kind of weight there that's going to help. The other one, it's unknowable, and that's why I have hesitation to put more than a small portion of the portfolio into crypto. Even though that would have been the right thing to do over the last decade, I still think it would have been a very risky thing and can lead to very bad outcomes.
Mm-hmm. Yeah, I mean, certainly, even in speaking with other investors, like the consistent thing that I've always heard is have a relatively conservative allocation to whatever kind of crypto or alternative assets kind of writ large, just because like the variability of them can be really high, and they're just a little bit more, I guess, obscure to kind of wrap your head around like what you can expect from them. So I think your point is well taken there. Let's get to our next question. What do we have on tap? Rod wants to know, one of the fastest growing demographics is people over 100. I learned something today. How does this affect your thesis, Nick?
I mean, it reiterates the importance of starting early. It reiterates the importance of taking care of your health. And so, like, we're like, oh, Nick, I'm going to have a 50 or 60 year period where I might be retired or something, or even something like that. Then you really need to think about your investments even earlier. Like, it doesn't change too much. I mean, if you really look at like the longevity research the portfolio longevity research and like, sequence of return risk and all those types of things, like, you just have to withdraw a smaller portion of your portfolio or have a larger portfolio when you're going to retirement. And so that's not great, but that's one way to kind of counteract some of these things.
I know it sort of varies for different people, but I'm curious, sometimes in the past we've heard people might want to plan their retirement out to like age 90 or something like that. Given people are living longer than ever, do you think that rule of thumb has changed? Like, do we need to start thinking about 100 or 110 even as a planning frame if you just want to sort of, I guess, cover your butt?
I mean, you could. I think if you actually look at what retirees do, though, I think it's unnecessary because so many retirees, their portfolio balances end up going up even as they're pulling money out, right? And so most people don't even pull money out. They just live off the interest or the income from the portfolio. So very few people, if you actually look at like the surveys in the United States, it's only 2 in 7 retirees, only 2 in 7 are actually pulling money out of their portfolio, right? The other 5 and 7 are the ones that are actually just like pulling out less than what it's generating or pulling out nothing, just living off the income, right? So most people, their principal balance is going up over time. And so it's kind of shocking to think that, but that's why when they pass, all those assets get passed on. And that's why there's these sometimes large inheritances. So I think the bigger issue for most retirees, if you look at the data, is not them running out of money. It's them not spending enough in retirement and their portfolio just keeps growing and, they just die with a ton of assets, which, I mean, is that a mistake? I don't know. It's debatable.
That's another one of those like invisible risks that's kind of hard to quantify in a lot of ways because, obviously nobody wants to run out of money, but there's real opportunity cost to leaving so much money on the table too. So something to consider, but thanks for pointing that out. Let's get to our next question. This one from Edwin. Edwin wants to know, as a level 3 investor, what would be the first step to move to level 4?
Keep investing. Keep doing it. I mean, raise your income, keep saving, keep investing, and just give it time. Right, that's the simplest way to do it, but it takes time, and you'll get there eventually. You keep saving, and just you got to keep at it. There's no shortcuts there.
Just in terms of, I guess, getting started with, to your point earlier, the diversified income-producing assets. Like, if somebody was starting out investing, do you think that there are certain asset classes that make sense to focus on first over others, or is it really just come down to your personal preference kind of thing?
I mean, it comes down to personal preference. At the same time, I think people should get some experience with different asset classes so they know how they're going to react. Because the cost of a mistake when your portfolio is small is very small, right? Because I made this mistake. Okay, not a big deal. Like I lost a few $100s or a few $1,000s. Like at the end of your life, it's not going to make a difference. You don't want to make that mistake when you have a $100,000 or $1 million portfolio. So getting that like experiential learning with your portfolio and with investing is going to be much better early on than it is if you do it later. So if you were like, I don't know what it's like to own some Bitcoin, own some of this, own little pieces of this, how do you feel about it when it goes down? How do you feel about it when it goes up? Think about your emotions and how you're processing that as an investor, and then set your portfolio from there. I think that's probably the most important thing, because watching that number go up or down is going to tell you a lot more about your risk tolerance than just about anything else.
Mm-hmm. Okay. Philip's got a question for us. Let's get to our next question. Dental, excuse me, sorry. How much should a stock pay in dividends for you to consider it income producing? Is there a line in the sand, Nick, for you where it qualifies as a true dividend stock?
So maybe I wasn't it's a little bit vague when I say income producing. A stock does not need to pay a dividend to be income producing, right? I think the issue is there's been a change in corporate finance and how, companies, managements run their companies. Historically, what they would do is they would just take that money and they pay it as a dividend. Now, some of those companies do buybacks. A lot of them will take that money and reinvest it in the company. I think all three of those are income producing assets. They're just different. One's going to show up in a faster rising share price. The one that's paying dividends is not necessarily, the share price isn't going to go up as much because they paid you the dividend. So on a total return basis, they would be the same, right? Assuming the return on the invested capital is the same as the return you would get, in the market. So overall, it doesn't matter whether they pay a dividend. It's something that's visual. And if you like that, great. Own dividend ETFs, diversified dividend ETFs, that's fine. But you do not need dividend producing stocks to have income producing assets or income producing stocks in your portfolio.
Mm-hmm. Okay, good point of clarification. I think we have time for one more question. This one from Frank. Let's see what Frank wants to know. I understand that asset allocation is a personal decision. Do you recommend any resources to help determine asset allocation based on your age? Anything off the top of your head that you can throw out there, Nick?
I'm not just trying to plug myself, but I actually just wrote about this recently. Well, I think age is a decent proxy, but it's not perfect. And the reason why is because every person's different. You can have people at 40 that have very different profiles. You can have someone who's 40 years old, single, doesn't want to have a family, like has a very high income. You could have someone who's 40 years old, has a partner and a few kids, right? That's a very different liability profile, and their investment portfolio should look very different, even though they're both 40, right? That's just a simple example, but you see my point. Like the idea here is, oh, you should just look at your age and do that. Like, no, you need to think about what are the liabilities in my life? What are the things what are the risks I need to worry about? That's what's going to set your allocation, not just your age. Your age is a factor, but it's not the only factor. So I have a blog post out there. If you just search allocation on my blog, I bet you'll find it. It was pretty recent. So you can go there and ask about that.
All right, great thing to throw out there. I'm a regular reader of your blog, Nick, so definitely I know I'll be checking out that post as well. That is all the time that we have. Appreciate you taking so many questions from our viewers. Fantastic questions, fantastic answers as well. And we appreciate you sharing your tips to climbing the wealth ladder. Fascinating concept. I think it's a great book, and perhaps we've inspired people to pick up a copy over the holidays and check it out as they start planning out their new year and stuff like that. But really appreciate you joining us, Nick. It's always a pleasure to talk to you.
Thanks again, Rob. Appreciate your time. And if any of your viewers have questions, feel free to DM me on LinkedIn or Instagram, or you can find my email on my blog. I respond to every DM.
Really appreciate that. Thanks for putting that out there. Nick, pleasure talking with you. And of course, to our audience, thank you for tuning in as always. Make sure you check out next week's episode. We are digging into some of the biggest mistakes that investors make with bond ETFs that can cost them big bucks if they're not careful. Trevor Cummings from TD Asset Management is going to join us with some of his tips to avoid those pitfalls. Good timing on this one because a lot of people are going to be rebalancing their portfolios at the year end, and maybe bond ETFs are going to be part of the mix, just given how strong of a stock market we've seen over this last year, albeit with some volatility. So make sure you tune into that one. That's all the time we have for this edition of the show. From everyone at Inside Investing, thanks as always for watching. We'll see you all next time.
Have more questions? Check out the links to the right and in the description below.